Hi, this is Dr. Bear. Today's lesson is going to cover the accounting equation. And if you watched my first video, I briefly touched on the accounting equation. So today we're going to dig a little bit deeper into understanding the accounting equation. So basically the accounting equation, as I have it listed here, is assets equal liabilities plus stockholders' equity. Another way that you can state this equation, which probably makes a little more sense as we begin talking about it, is to say that assets minus liabilities, I think I misspelled that, is equal to equity. Now, whether you call it equity, whether you call it stockholders' equity, there are different ways to define equity. When you're referring to stockholders' equity, we're talking about a public company that has sold stock ownership to public investors. But equity is still equity. It's the same idea. Now, when you're looking at the accounting equation, what we show is everything of value that the business owns, all of the assets. They have value now and future value. Liabilities are the debts that the business owes. So anyone that you owe a liability to, whether it's a bank that you owe a loan payment to, a vendor that you've purchased items from that you're making payments on, anything that you owe. It could be that you owe products and services to your customers. Those are liabilities. Those are claims against the assets. Someone has a claim against the assets of the company, whether those assets are cash or equipment or other items like that. Equity is the owner's claims to the business. But in order for an owner to be able to claim any equity from the business, the liabilities must be satisfied. So it's better to look at the equation as assets minus liabilities are equal to equity. Because if a business, let's say, is going to liquidate, they're going to go out of business, you have to satisfy all of those liabilities before the owners can take any of the value of that company. Now, as I touched on in my previous video, that does not mean an owner cannot take a draw or withdraw money or payment or even other assets from the business while the business is in operation. It's just that if the business is going to close or go out of business, you must satisfy all the liabilities before the owners take any other value from the company. Now, this accounting equation is a mathematical equation. It must always remain in balance. So when we get into posting transactions into the accounting system, and I start showing you how to do that, the key is always going to be making sure the accounting equation remains in balance. And if you watched my previous video, I touched on the fact that accounting is a dual entry system, which means every transaction is going to affect at least two accounts in your accounting system. You're going to have a debit and a credit. The debits and the credits must always be equal. That's what keeps this accounting equation in balance here, is the equality of the debits and credits. And down here, I've given you a little scenario, a little summary of how debits and credits affect the different elements of the accounting equation. Debits always increase your assets. Credits always increase your liabilities and your equity. Now that's going to throw some of you, because some of you, because of your experience of dealing with having a bank account and hearing the terms debits and credits used in the process of your banking relationship, you've walked away with a misunderstanding that a debit is a decrease and a credit is an increase. That's only true in certain cases. So I'm going to post an entire discussion on just debits and credits and how to get a new understanding of debits and credits separate from this. But for now, I just want to introduce you to this. So debits always increase your assets. Credits always increase your liabilities and your equity. So if you look at this accounting equation, the assets are on the left side of the accounting equation. Liabilities and equity are on the right side. Debits increase everything on the left side of the accounting equation, and they decrease everything on the right side. Credits increase everything on the right side of the accounting equation, but decrease everything on the left side. Now, when we talk about revenues and expenses, when your company is generating revenue and paying the expenditures related to the generation of that revenue, that has a direct effect on your equity. Revenues are going to increase your equity. Expenses are going to decrease your equity. They all get rolled up into this account called retained earnings. We're going to go more in depth into that in later videos. I'm not going to get in depth to it here so I can keep this short. But down here, I've showed you how debits and credits are affecting your revenues and your expenses. Now you'll notice a credit increases revenue, just like it increases equity, because as your revenues are increasing, it's causing equity to increase. Credits increase equity. On the other hand, though, as you are paying expenditures, debits increase your expenditures. As your expenditures are increasing with these debits, is causing a decrease to your equity. Remember, debits decrease your equity. So the increase of expenses through debits is causing a direct decrease to your equity. So we'll get into that a little more later. Now back to the equality of the accounting equation. Anytime you are posting transactions, some students have a misunderstanding that, oh, well, I can increase my assets, I'm decreasing my liabilities. No, that does not keep this equation in balance. If you increase on the left side of the equation, you must have an equal increase on the right side. If you decrease on the left side, you must have an equal decrease on the right side. The only time you'll have an increase and a decrease is if your transaction is only affecting one side of the accounting equation. For instance, if I spend cash to buy another asset like a piece of equipment, I'm going to decrease my cash asset, I'm going to increase my equipment asset. I would have a decrease and an increase there. But if you're posting transactions that affect both sides of the equation, you're going to either be increasing both sides or decreasing both sides. That keeps that equation in balance. Balancing is a very critical key to being able to be successful at accounting and posting the transactions. And having this accounting equation in the back of your mind when you are posting those transactions will help you be able to identify when to debit and when to credit. And when we start looking at some actual transactions and I start talking through those, I'll help you start learning how to analyze each transaction and figure out what accounts are being affected, whether those accounts are assets or liabilities or equity accounts. So then you'll have a better understanding of whether you are posting a debit or a credit to these accounts. And you'll also notice here on my screen, I've posted the word normal here and here and here and here and here. The normal balance of an asset account is a debit balance. So if you add up all of the entries to an account that's an asset account, its ending balance should be on the debit side. It should normally have a debit balance. Conversely, liabilities and equity accounts normally have a credit balance. And again, the normal balance of a revenue account is a credit and the normal balance of an expense account is a debit. So whatever increases the account is what its normal balance should be. If you have an account that normally has a debit balance, but when you add up all of the debits and credits in that account and you end up with a credit balance, it may or may not be an error, but it's a key indication that you probably have an error somewhere. That doesn't mean that an account with a normal debit balance can never have a credit balance. Sometimes that happens. For instance, if you have a liability account and you have overpaid that liability, you'll end up with a debit balance in that liability account. That's a key there that you can spot when you're looking at your financial statements that, oh, we overpaid a bill, we're due some money back, or we're going to reduce the payment on the next bill that we pay them. So that's just an indication for you when you see something like that, that either there's an error or there's something you need to analyze within that account to find out why it does not have a normal balance. Now, one last thing, and then I'm going to stop this video. I'm going to do one on a discussion of understanding debits and credits, and then we will actually get into actually posting transactions. I just wanted to show you some of the types of accounts that you're going to see that would be normally an asset or a liability account. Assets are your cash, your accounts receivable. An accounts receivable is an indication that a customer owes money to you. So perhaps you sold something to a customer on credit, you're allowing them to pay you later. Prepaid expenses. Anytime you pay for an expense in advance of when it's due, like you might prepay your insurance or prepay your rent, those are also assets. Though you have paid for something you don't owe yet. So someone owes you something in return at a future date. It's something that has a future value. And then, of course, property, plant, and equipment. These are the hard, tangible assets that you can touch. You know, your building that your business is located in, the computers sitting on the desks, the equipment that you operate in the warehouse to produce your goods or whatever. Those are all assets. Liabilities accounts include anything you owe to someone else. So an accounts payable means you owe money to a vendor or creditor. A notes payable is more of a formal loan, like a bank loan. Unearned revenues. If a customer pays you in advance of receiving the goods or services that they've paid for, you owe something to the customer. So until the customer gets what they've paid for, that is unearned revenue. So it's a liability for you. And then you have accrued expenses. We'll talk more about accruals much, much later when we start getting into accrual basis accounting versus cash basis accounting. So that's the end of this lesson for today. Please be sure you watch the next lesson on debits and credits, because that will be a very critical lesson for your understanding as we move forward on how to actually post transactions. So thanks for joining. Subscribe to this channel and be sure you check out the other videos.